Welcome to this lecture on the new rules for non-doms. Initially, in this lecture, we're going to look at income tax and CGT. Now, when you're preparing the 17-18 tax return, you'll be aware that you've got new rules for non-doms. That is clients that are UK resident, but non-dom. Now, that means they can have the remittance basis. In some cases, when they've been here so long, they've got to pay for the remittance basis. But what we're looking at is those clients that are UK resident, but for whatever reason are non-dom. Now, from the 6th of April 17, i.e. for the 17-18 tax return, we have a new system. Now, there are no changes to the common law rule of domicile. We've still got domicile of origin, dependency, choice. That doesn't change. But we have new rules, and these new rules that only affect non-doms, but effectively what we've got going forward is deemed doms. So they're not domiciled by origin, dependency or choice, but they are deemed to be domicile. Now there will be two populations that will be deemed domicile from the 6th of April 17. Firstly, long-term residents. Secondly, formerly domiciled residents, FDRs. Now, because they'll be deemed domicile from April 17, both categories will be taxed on the same basis as UK residents, UK DOMs. That is, they pay tax on worldwide income and gains. They do not have access to the remittance basis. That disappeared on the 6th of April 17 when they became deemed domicile. So let's look at category 1, long-term residents. Now these are individuals who have been resident, UK resident, in 15 or more of the preceding 20 tax years. So they've been resident for a long, long time, but they've never been domicile. But from April 17 they will be, if they've been here for 15 out of or more of the preceding 20 tax years. They will then be deemed domicile from the start of year 16. Now, in counting these 15 out of the previous 20, split years count as a year of residency. So let's look at the second category, formerly domiciled residents. Now, these are non-UK DOMs. They were born in the UK and they had a UK domicile of origin. But for the last however many years, they haven't been in the UK. And they might well have acquired a domicile of choice elsewhere. So, for example, let's say they were born in the UK and they lived here for 3 or 4 years. And then when they were, say, 4, their family moved to Australia. And they've been there ever since. Now, when that person that was born in the UK comes back to work in the UK, whenever they are UK resident in the UK, there will be a deemed domicile under the formerly domiciled residence rule. Brits coming back to the UK effectively. Now, connections are relevant for this test. If you are born here, then whenever you are UK resident here, you will be deemed domicile here. Now, they're the two categories. Now, there are many consequential amendments because of these two new categories from April 17. First of all, let's consider the £2,000 rule. Now, this is automatic remittance basis if the unremitted foreign income and gains is under £2,000 per annum. Now, this rule strangely continues even for deemed DOMs. It is the only time a deemed DOM can use the remittance basis. There are changes to the remittance-based charge. Now, this continues for non-DOMs claiming the remittance basis. But because of this new long-term residence test, the £90,000 remittance-based charge is now obsolete. The 1720s are now deemed domicile as a 1520, i.e. in years, 17 out of 20 years, 15 out of 20 years. So therefore they are deemed domicile and they are unable to use the remittance basis. Those that haven't been there that long, they can still pay to use the remittance basis, and that payment is $30,000 or $60,000 depending on how long they've been here. So for those UK residents but non-dom and non-deemed dom, they can still do remittance basis as before. But obviously, the longer they've been here and continue to be here, the more likely they are to become deemed domicile. And when you're deemed domicile, you simply do not get the remittance basis. Well, let's look at CGT rebasing. Non-doms using the remittance basis only pay CGT on foreign gains if those gains are remitted. Now that's this date of play before April 17. Now it would be unfair to tax these deemed domiciles on gains that accrued before the new regime was implemented. They might be sitting on an asset overseas, knowing that as long as they never remitted it, then they're never going to pay tax on it in the UK. Then along come these new rules. And these new rules make them deemed domicile from April 17. But a lot of the gain arose before that date. Now they might think it's fair to have CGT rebasing available to them. Now there is a CGT rebasing rule for these deemed domiciles. So gains on non-UK assets are calculated using April 17 values, and this does extinguish gains on foreign assets pre-April 17. However, there's a massive but with this. CGT rebasing is only available for qualifying individuals. Now those qualifying individuals are those that were deemed domicile on the 6th of April 17 under the long-term residence test, the 1520 rule, and they had paid the remittance-based charge in any year pre-April 17. Now, for my money, that's going to be a very small number that get rebasing. It's not going to be available to any of these deemed DOMs that became deemed domiciled post 1718. It's not going to be available for those formerly domiciled residents, and it will not be available for anyone who has never paid the remittance-based charge. So yeah, there is rebasing, but it's not going to apply to many people. Essentially, when you become deemed domicile, and you realise a gain on a foreign asset, that will be taxed in the UK. And it'll be taxed in its entirety in the UK, because for most there will not be this rebasing. Now finally, let's look at mixed fund cleansing. Now the mixed fund rules, they are difficult to navigate, but generally, if you assume income is remitted before gains, and gains are remitted before capital, then you won't go too far wrong. Now there's a 2-year window to segregate mixed funds into their component parts. What we should be aiming to do is isolate clean capital into a new bank account, and that new bank account, being clean capital, can be remitted tax-free. Now the cleansing window closes on the 5th of April 19. It is available to all remittance-based users, and it is best they take advantage while they can. After April 19, there will not be the ability to do this mixed fund cleansing. So going forward, income before gains, gains before capital. So best cleanse those mixed funds as soon as possible. It's less than a year before this disappears. So they're the new deemed domicile rules for income tax and CGT. Those deemed domiciles will be taxed on worldwide income. The remittance basis is no longer available to them. Just a quick point or a quick caveat. If they have realised a gain prior to becoming deemed domicile, then when they do remit that, then they will pay tax on that remittance. Otherwise, that gain won't have been taxed in the UK. So there isn't this remit everything afterwards because you're worldwide income. So there is a little crossover there. So if you did realise a gain before you became deemed domicile and you haven't remitted it, then you can't remit it post deemed domicile and not expect to pay tax on it. Well, that concludes the lecture on deemed domicile, the income and CGT rules that kick in from April 17. My name's Dean Wootten. Thank you for listening.